February 12th, 2026. A pension fund manager in Munich receives an email marked urgent. The subject line reads, Rebalancing Protocol Alpha 7. She's never seen this protocol activated before. It's the one they use when a G7 economy is about to implode. She opens it. The instructions are simple. Sell everything tied to Japanese debt. Do it quietly. Do it now. 3 days later, $840 billion moves across borders in what traders will later call the silent stampede. But here's what makes your stomach drop. This isn't about Japan anymore. This is about the mathematical law that governs every heavily indebted nation on Earth. And that law just went from theory to execution. When a country borrows more than it can ever repay, two doors appear. Behind door number 1, defend your currency by raising interest rates until your government bankrupts itself paying interest on old debt. Behind door number 2, print unlimited money to suppress those rates and watch your currency disintegrate as imported inflation devours your population's savings. History has opened both doors. Both times, millions lost everything. And now, for the first time in 3 decades, Japan is standing in that hallway deciding which door to open. Let that sink in for a moment. The third largest economy on Earth, the nation that wrote the playbook on monetary stimulus, the country that convinced the world you could print money forever without consequences, they just discovered the bill always comes due. And when their bill arrives, yours does too. Let me take you back to September 1992. Black Wednesday. Britain is trying to stay in the European exchange rate mechanism, which means keeping the pound stable against other European currencies. But there's a problem. Britain's economy is weak, unemployment is rising, the government needs to cut interest rates to stimulate growth, but to stay in the ERM, they need to keep rates high to make the pound attractive. It's a mathematical contradiction, and George Soros sees it. He doesn't see it because he's evil or unpatriotic. He sees it because the math doesn't work. You cannot simultaneously stimulate a weak economy and defend an overvalued currency. It's like trying to accelerate and brake at the same time. Physics doesn't allow it. So Soros and other hedge funds begin betting billions against the pound. They're essentially saying Britain will have to choose growth over currency defense, and when they do, the pound will crash. The Bank of England panics. They raise interest rates from 10% to 12% in the morning, then to 15% by afternoon. They're trying to make the pound so attractive that investors stop selling. Simultaneously, they're burning through foreign currency reserves, buying pounds in the market to prop up the price. 8 hours of this, 8 hours of fighting the inevitable. Then they surrender. The pound collapses 15% overnight. Britain gets forced out of the European exchange rate mechanism. The political class calls Soros a villain, a speculator who broke the Bank of England. But that's not what happened. Soros didn't break anything. He simply recognized that when a heavily indebted government faces a mathematical impossibility, the math always wins. The mechanism executed exactly as predicted, not because of malice, but because of arithmetic. Now let's fly to Bangkok, July 1997. The Thai baht is under attack. Thailand has been borrowing heavily in US dollars to fund a real estate boom. Thai developers take out dollar loans, build condos, sell them for baht, then convert the baht back to dollars to repay the loans. This works beautifully as long as the baht stays stable against the dollar. But speculators see the same mathematical contradiction Britain faced. Thailand's economy is slowing. They need to devalue the baht to make exports competitive. But if they devalue, all those dollar loans become impossible to repay. The government chooses door number 2. Instead of raising interest rates and crushing the economy immediately, they print baht and use it to buy dollars in the market, trying to hold the exchange rate stable. For a few months, it works. But here's the thing about printing money to defend your currency. It's like trying to put out a fire with gasoline that's been diluted with water. Eventually, you run out of water and you're just pouring gasoline. Within 6 months, the baht collapses 50%. Indonesia's rupiah falls 80%. Why? Because when you print more of something, it becomes worth less. And when you're a small, open economy that imports energy, food, and machinery, a currency collapse means imported inflation. Indonesia sees consumer prices rise 70% in a single year, not over a decade. 1 year. Rice, which is the staple food, doubles in price, then triples. Families that could afford 3 meals a day are now choosing which family members eat. Food riots break out in Jakarta. The military opens fire on protesters. The government falls. The IMF steps in with emergency loans, but the conditions are brutal. Slash government spending by 15%, raise interest rates retroactively, accept foreign control of your banking system. Printing to escape the trap didn't work. It just determined which kind of collapse they got. Now let's talk about Greece, 2010 to 2015. Greece tries something different. They try both doors simultaneously. First, they raise taxes and cut government spending to prove fiscal responsibility to bond markets. Doesn't work. Bond yields hit 30% anyway. Then the European Central Bank secretly prints euros and buys Greek bonds through back channels to suppress yields. Also, doesn't work. Greece requires 3 separate bailout packages totaling 289 billion euros. And even with unlimited ECB support, even with Germany and France backstopping the entire operation, Greece still loses 25% of its GDP. An entire decade of economic growth gone. Youth unemployment hits 60%. Doctors and engineers emigrate to Germany and Australia. The country that invented democracy becomes a laboratory for fiscal sadism. Both doors led to disaster. So here's the question you're probably asking. If both choices lead to disaster, why do countries keep ending up in this hallway? Because the hallway is built into the system. When you run deficits year after year, when you promise more in pensions and healthcare than you collect in taxes, when you borrow to cover the gap and promise to repay later, you're walking toward that hallway. And the longer you walk, the fewer exits you have. Japan has been walking for 30 years. Let me show you the math that makes escape impossible. Japan's total government debt is 1,200 trillion yen. That's about $9 trillion. Their GDP is 600 trillion yen. Debt is 250% of GDP, the highest ratio of any major developed economy. Right now, the average interest rate on all that debt is about 1.2%. At that rate, Japan pays 14.4 trillion yen per year in interest. Japan's total tax revenue is 20 trillion yen, so about 12% goes to debt service. Uncomfortable, but manageable. The government can still fund healthcare, pensions, infrastructure. But here's where it gets ugly. The 40-year Japanese government bond now trades at 4.24%. If bond vigilantes push the entire yield curve to 4%, and they're trying to, interest payments jump to 48 trillion yen per year. 40% of every yen the government collects in taxes goes straight to interest payments. Not schools, not hospitals, not pensions for the oldest population in the developed world. Just interest on old debt. Make this tangible. Imagine you earn $120,000 per year, but your mortgage interest alone is $48,000 annually. You still have to pay for food, utilities, healthcare, your kids' education, car payments, insurance. And you cannot default on the mortgage, you cannot sell the house, and your interest rate keeps rising every month. That is Japan's position right now. There is no budget cut that solves this. The hole is too deep. So they look at door number 1, financial repression. The United Kingdom tried this after World War II. In 1946, UK debt was 250% of GDP, almost exactly where Japan is today. The Bank of England kept interest rates artificially low, well below inflation, for 2 straight decades. Real interest rates were negative 2 to 4% throughout the 1950s and 60s. Government bonds lost purchasing power every single year. Savers were slowly destroyed, but the debt got inflated away. By the mid-1970s, UK debt had fallen to 100% of GDP. It worked, technically, but an entire generation paid the price. If you retired in 1946 with £100,000, by 1976 it could only buy what £40,000 bought in 1946. That's financial repression. You don't default. You just make the currency worthless enough that the debt becomes manageable. Japan could do this. Print 50 trillion yen, 100 trillion, whatever's necessary to buy their own bonds and hold yields down by force. On paper, this solves the debt service problem. In reality, currency markets react instantly. The yen is already trading at 160 per dollar, weak by historical standards. If the Bank of Japan announces another massive quantitative easing program, the yen goes to 180, maybe 200 per dollar. And here's why that's catastrophic. Japan imports 85% of its energy and most of its food. A 25% collapse in the currency means 15 to 20% inflation on everything Japan buys from abroad. Energy prices double, food costs spike. And here's the psychological break. Japan has run near zero interest rates for 30 consecutive years. An entire generation has never experienced sustained inflation. Savings accounts pay effectively zero, bonds pay zero. The Japanese population has been psychologically conditioned to believe holding yen is completely safe. But if the Bank of Japan prints aggressively, that belief shatters. And once inflation expectations break, once people stop believing the yen will hold value, the spiral becomes self-reinforcing. Everyone tries to spend currency before it loses more value. This increases the velocity of money, which accelerates inflation further, which makes everyone want to spend even faster. It's not just an economic spiral, it's a psychological break. And once that break happens, it's nearly impossible to reverse without draconian interest rate hikes that would bankrupt the government. So they look at door number 2, austerity. Italy tried this in the 1990s. In 1992, Italy's debt hit 120% of GDP. The lira came under attack. Italy was forced out of the European exchange rate mechanism. Bond yields spiked to 14%. The government had to choose between default or cut spending. They chose austerity, cut government spending by 7% of GDP, raised taxes dramatically, accepted EU bailout terms that included foreign oversight of fiscal policy. Brutal. Unemployment spiked above 12%. GDP growth collapsed. Even after all that, it took 15 years to bring debt back under 100%. Japan's trap is worse than both historical examples. The UK in 1946 had a young population, growth ahead, and empire remnants to tax. Italy had the European Union to bail them out. The ECB could print euros and buy Italian bonds when yields hit 14%. Japan has none of that. Japan has the oldest population in the developed world. 30% of citizens are over 65. The workforce is shrinking by 600,000 people per year. There is no growth on the horizon, and there is no one to bail them out. The Federal Reserve will not print dollars to buy yen and Japanese government bonds. The IMF's total lending capacity is under $1 trillion, nowhere near enough to stabilize a $9 trillion bond market. China, dealing with its own property crisis and holding $3 trillion in reserves, is not going to rescue Japan. Japan is simultaneously too big to fail and too big to save. Let me walk you through what happened on January 20th, 2026, minute by minute, 9:47 a.m. Tokyo time. Prime Minister Takaichi announces 21.3 trillion yen in stimulus, the largest in Japanese history, and calls a snap election for February 8th. Markets pause for 12 minutes. Portfolio managers are reading the announcement. Algorithms are recalibrating. Then 10:15 a.m., Japanese government bond yields explode. The 40-year JGB jumps from 3.94% to 4.09% in 28 minutes. 15 basis points. Normal daily movement is 3 or 4 basis points. This is 5 times that in half an hour. 10:43 a.m. First circuit breaker triggers. Trading halts automatically when volatility exceeds preset thresholds. Resumes 5 minutes later. Yields keep climbing. 11:18 a.m. Second halt. Yields hit 4.18%. 24 basis points in 91 minutes. Traders are using the word unprecedented in Bloomberg chats. 11:50 a.m. Third halt. Never happened before. 3 circuit breakers in one session. When trading finally stabilizes, 40-year yields reach 4.24%. 30 basis points higher than the open. A move that normally takes an entire month just happened in under 2 hours. Behind the scenes, Japanese life insurers are recalculating. They hold $1.1 trillion in US treasuries. For 3 decades, the logic was simple. JGBs yield nothing, so buy US treasuries at 3 to 4%, hedge the currency risk, earn the spread. Worked perfectly, but it just inverted. JGBs now yield 4%, US treasuries yield 4.3%, hedging costs 50 basis points. Do the math. 4.3% minus 0.5% hedging equals 3.8% net. JGBs pay 4% with zero currency risk. The trade no longer works. Emergency meetings at Nippon Life, Dai-ichi Life, Meiji Yasuda. Together, they control over 1.1 trillion in US treasuries. The decision is unanimous. Sell US treasuries, buy JGBs. It's not politics, it's math. Why take currency risk for lower returns? 3 p.m. Tokyo time, 1 a.m. New York time. US Treasury markets open. 10-year yields spike from 4.18% to 4.31% in the first hour. 13 basis points. The market knows what's coming. Over $1 trillion in forced selling. And bond markets hate forced selling by large institutions. It creates a liquidity vacuum. 6 p.m. Tokyo time, European bond markets open. German bunds jump 18 basis points. French OATs, already under pressure from pension strikes, surge 22 basis points. Italian BTPs spike 31 basis points. Pure contagion. Not from European news, but because Japan's anchor moved and every ship in the harbor started drifting. 9 p.m., emerging market currencies cascade. Thai baht drops 3.2%. Korean won falls 2.8%. Philippine peso loses 2.1%. Why? Because Japanese capital has funded carry trades across Asia for years. Borrow yen at zero, invest in higher-yielding Asian bonds, pocket the spread. Now, as the yen strengthens with capital returning home, those carry trades unwind violently, forced liquidation across the region. The Nikkei closes down 2.1%, but it had been down 4.7% intraday before a mysterious late rally. Rumors circulate that the Bank of Japan bought 2.3 trillion yen in JGBs during the session to prevent total collapse. Unconfirmed, but the price action suggests someone with unlimited firepower intervened. An anonymous Tokyo bond trader tells Reuters, "This is not a market, this is a revolt." A hedge fund manager in New York says Japanese insurers are explicitly telling Washington, "Your deficits are no longer our problem." Now here's where this becomes your problem. When Japanese insurers sell 1.1 trillion in treasuries, who buys them? The Fed stopped quantitative easing. China has reduced holdings by 300 billion since 2022. Europe and Middle East buyers are maxed out. No natural buyer means yields must rise. The Treasury must offer higher rates to attract new buyers. Every 50 basis point rise costs the US government $180 billion yearly in additional interest. The US has 36 trillion in debt. If 10-year yields go from 4.3% to 5%, annual interest payments jump from 1.8 trillion to 2.5 trillion. US tax revenue is 4.9 trillion. 51% would go to interest. One bad auction away from Japan's trap. The Treasury Secretary has already complained publicly. Recent movements in Japanese capital markets are destabilizing global bond markets. Diplomatics speak for stop selling our bonds, but Japan isn't attacking. The math changed. When $1 trillion moves based on mathematics, politics cannot stop it. So who else is vulnerable? Start with the United States. 36 trillion in debt. $2 trillion deficits yearly. Now losing Japan as a reliable buyer. The same pattern hit the UK in 1976. Britain was running deficits. Foreign buyers stopped showing up, and they needed an IMF bailout with brutal austerity conditions. Could happen to the US. Next, the United Kingdom. Post-Brexit, they've lost the EU backstop. Debt is 100% of GDP and rising. Pension funds are still scarred from the 2022 liability-driven investment crisis. Remember when Liz Truss announced tax cuts? Gilt yields spiked 100 basis points, and pension funds faced 200 billion in margin calls? The Bank of England had to do emergency quantitative easing. Truss resigned in 44 days. If global yields rise and gilts spike another 100 basis points, same margin calls. The BOE would be forced to print again. At some point, markets stop believing central banks can control yields. Then France. Macron's pension reform triggered nationwide strikes and political instability. Debt is 110% of GDP and rising. French OAT spreads over German bunds have widened from 40 basis points in 2023 to 80 basis points now. The market is charging France more to borrow because of political risk. If vigilantes successfully attack Japan, France is next. and it's not clear the ECB has the credibility it had in 2012 to defend them. Now let's talk about the triggers. February 8th, election day in Japan. If Takaichi wins, the stimulus is confirmed. Yields rise. If the opposition wins, they've promised even more stimulus, 30 trillion yen. Yields rise anyway. The election isn't about whether this happens, it's about how fast. Game theory comes into play here. Imagine you're a Japanese insurance company portfolio manager. You know an election is coming. You know that after the election, JGB yields will be higher. You know everyone will be selling treasuries and buying JGBs. Do you wait and sell into a falling market? Or do you front run everyone else and sell now while treasury prices are still high? The rational move is to sell first. So the selling accelerates before the election, not after. February 8th is the trigger, but repositioning is already happening. For US viewers, understand this. The decision being made in Tokyo right now will determine what happens to your savings, your bonds, your pension, your 401k. Japanese insurers sell 1.1 trillion in treasuries. Treasury prices fall, yields rise. Everything from mortgage rates to corporate borrowing costs to government financing costs goes up. The Fed could print money to buy treasuries and stabilize yields, but that reignites inflation. Or the Fed stands aside, yields rise, borrowing becomes expensive, recession risk increases, there is no good option. Japan's crisis becomes America's crisis mechanically, automatically. When the anchor breaks, every ship drifts. Here's what almost no one is talking about. Japan has been the anchor of low global interest rates for 30 years. When Japan kept rates at zero, it created a baseline. If Japan pays zero, everyone else can pay relatively low rates. But when Japan's rates rise to 4%, that baseline shifts. Suddenly, every other country's borrowing costs look cheap relative to Japan, which means global yields have room to rise. It's like when the biggest house in the neighborhood sells for twice what anyone expected. Suddenly, every other house gets reappraised upward. Japan just got reappraised. And when you're running trillion-dollar deficits like the US, or issuing 100-year bonds like Austria, or holding a currency union together with negative rates like the ECB, you are next in line. The mechanism doesn't care about your politics or your intentions. It executes when the math stops working. And the math is stopping. So what do? First, understand that so-called safe assets, government bonds, risk-free treasuries, they are not safe when bond vigilantes revolt. The safest investment in the world can become the most dangerous overnight when the underlying math breaks. Second, understand that holding assets denominated in a currency whose government prints money to service debt is choosing financial repression. You are choosing to have your purchasing power slowly confiscated. Third, understand that by the time mainstream media calls this a crisis, repositioning is already complete. Smart money moves on patterns, not headlines. You are seeing this 11 days before the Japanese election. Mainstream media will cover it 11 days after, when it's already over. This is not prediction, this is pattern recognition. The same mechanism broke the Bank of England in 1992. The same mechanism collapsed the Asian tigers in 1997. The same mechanism nearly destroyed the Eurozone in 2012. That mechanism is executing in Japan right now. We are at stage 3 of 4. Stage 1 was the initial yield spike on January 20th. Stage 2 is the repatriation trade, Japanese insurers selling treasuries. We are here now. Stage 3 is contagion to other vulnerable countries. Stage 4 is systemic crisis, when markets realize no central bank has the credibility or resources to stop this. This time is different because Japan is not a small emerging market. Japan is the third largest economy on earth. Japanese investors hold trillions in assets globally. The yen is a major reserve currency, and no institution has the resources or the mandate to bail them out. The IMF cannot. The Fed will not. China has its own crisis. Japan is too big to fail and too big to save. When they hit stage 4, the contagion will not stop at borders. You are watching the moment when 3 decades of monetary experimentation meets the immovable object of arithmetic. Japan convinced the world you could print money forever, run deficits forever, keep rates at zero forever without consequences. They were wrong. The bill always comes due. The only question is who pays it. Right now, Japan is deciding whether to pay it through currency collapse and imported inflation or through austerity and economic depression. Both choices destroy savers. Both choices end the same way. And when the third largest economy on earth makes that choice, it forces every other heavily indebted nation to make the same choice. Your instinct that something is fundamentally wrong with global debt levels, you are correct. Japan is proving it right now. The next 11 days will determine whether you understood this before your savings evaporated or after. The pattern does not require your belief to execute, it simply executes. Those who see the pattern while it is executing, not after it has collapsed, can position accordingly. February 8th triggers stage 4. Unlike 1992, unlike 1997, unlike 2012, this domino is large enough to take the entire global system with it. This is not a Japanese crisis. This is a global debt crisis. Japan is just the first domino, the most leveraged, the most vulnerable to rising rates. But the mechanism does not stop with Japan. It moves to the next most vulnerable country, then the next, until something breaks systemically or until central banks abandon all pretense of fiscal discipline and print unlimited amounts of currency, destroying its value. Either way, savers lose. The only question is whether you see it coming in time to adjust or whether you learn about it from a mainstream news headline after your retirement account has already been cut in half. You are seeing this now. You have 11 days.